A dream deferred is a dream denied. Langston Hughes wrote those words about America decades ago, and they ring true today, especially if you're talking about a key part of the American dream, home ownership. Welcome back to the mix. Please hit that like and subscribe button. I want to talk about these racist lenders, hurting our families and communities. With this racist madness, and what you should do about it, black women share the most harm from this mess. Let's begin. A recent Northwestern University study found that racial disparities in the mortgage market haven't declined much in the last 4 decades when it comes to discrimination in loan denial and interest rates. The study indicates that Black and Latino mortgage applicants are more likely to be declined than white applicants, and more likely to be offered high-cost loans if they're approved at all. According to a report from the Urban Institute, as of 2017, there was a significant gap in homeownership rates between whites and blacks. 72% of white Americans own homes compared to 42% of black Americans. In fact, there has been negative progress on home ownership rates in the 52 years since the Fair Housing Act was passed in 1968. The gap between black and white homeowners has widened, and black Americans saw a more dramatic drop in homeownership rates after the recession than white Americans. Lenders seem to have no problem just saying no. Nearly 1 in 10 borrowers get denied a mortgage, according to a 2019 Lending Tree report. That report also found discrepancies by race and ethnicity. African American borrowers have the highest denial rates, at 17.4%, and non-Hispanic white Americans have the lowest, at 7.9%. Race and ethnicity should not be a factor in determining lending decisions, says Samuel Dean, a financial planner with Dean Financial Partners. Yet, even with similar creditworthiness, whether face-to-face or online, the black community is unfairly being charged higher interest rates and refinance costs, a practice that is deeply rooted in systematic racism. After the housing collapse, a tight credit environment reduced the number of mortgage loans issued to potential homeowners with less than perfect credit, especially minorities. Research conducted by the Urban Institute in 2014 found a drop of as many as 1.2 million loans could be attributed to tightening credit, with African American and Hispanic borrowers disproportionately affected. Even now that some lending restrictions have been eased, a credit gap persists in America. Equal access to mortgage credit for minorities remains a serious issue, Lori Goodman, director of the Housing Finance Policy Center at the Urban Institute, tells NerdWallet. In fact, equal access to credit for all creditworthy borrowers is a major challenge. And, since minorities generally have lower credit scores than white, non-Hispanic Americans, this challenge disproportionately affects minority borrowers. I am hopeful that many of the unfair practices that we saw in the marketplace, particularly during the recent foreclosure crisis, are no longer present, Nikitra Bailey, executive vice president with the Center for Responsible Lending, tells NerdWallet. The passage of Dodd-Frank regulations sought to stem mortgage lending abuses such as balloon payments, teaser interest rates, and high fees, called fee packing. Today, lenders are required to make a good faith determination of a borrower's ability to afford a mortgage. We've solved some of the challenges in the marketplace, but we haven't eliminated mortgage discrimination, Bailey concedes. That discrimination often comes in the form of higher mortgage interest rates. Black borrowers pay home loan rates more than a quarter point higher than comparable white borrowers, according to research led by Ping Cheng of Florida Atlantic University, published in 2015 in the Journal of Real Estate Finance and Economics. The higher rates are most often given to young borrowers with low education and to black women more than black men, according to the paper. It is the more financially vulnerable black women who suffer the most, the study concludes. However, in many cases, mortgage discrimination surfaces not only in the form of higher costs, but also as barring access to a mortgage, and the discrimination can impact individual families and entire neighborhoods. In 2015, the Consumer Financial Protection Bureau and the Department of Justice accused Hudson City Bancorp, a Paramus, New Jersey bank, of engaging in the practice of redlining, excluding entire majority black and Hispanic neighborhoods in New York, New Jersey, Connecticut, and Pennsylvania from home mortgage lending services. The regulators announced a record-setting $33 million settlement with the bank in September. Lower-income families and moderate-income families and many borrowers of color have been pushed out of the marketplace. Now what we're wrestling with is figuring out a way to ensure that the market is actually serving all creditworthy borrowers. What is redlining? For decades, many banks in the U.S. denied mortgages to people, mostly people of color in urban areas, preventing them from buying a home in certain neighborhoods or getting a loan to renovate their house. The practice, once backed by the U.S. government, started in the 1930s and took place across the country. That includes in many of the nation's largest cities, such as Atlanta, Chicago, Detroit, Tampa, and others with large minority populations. As a result, banks and other mortgage lenders commonly rejected loans for creditworthy borrowers based strictly on their race or where they lived. As part of that practice, financial firms, real estate agents and other parties demarcated geographic areas that were effectively off-limits for issuing loans. Scholars who study housing discrimination point to redlining as one factor behind the gulf in wealth between blacks and whites in the U.S. today. Black families have lost out on at least $212,000 in personal wealth over the last 40 years because their home was redlined. Although we rarely see redlining, what we do see is a lot of reverse redlining. In reverse redlining, banks may engage in predatory lending in the same neighborhoods that were once marked as off-limits for borrowers, Rossman said. For example, in the years leading up to the 2008 housing crash, mortgage lenders peddled hundreds of thousands of risky subprime loans, including no-doc and balloon payment loans, on low-income borrowers. Many communities in cities like Detroit and Newark have yet to recover. Where does the word come from? The term redlining is a nod to how lenders identified and referenced neighborhoods with a greater share of people deemed more likely to default on mortgage. Using red ink, lenders outlined on paper maps the parts of a city that were considered at high risk of default, as well as more desirable neighborhoods for approving a loan. Riskier neighborhoods were predominantly Black and Latino. What you can do if mortgage lenders are racist. Federal regulations are clear. The Fair Housing Act makes it unlawful to discriminate in the rental or sale of housing, or to impose different terms and conditions of a transaction, based on national origin, race, color, religion, sex, familial status, or disability. And the Equal Credit Opportunity Act bans credit discrimination based on race, color, religion, national origin, gender, marital status, age, and if a borrower receives income from any public assistance program. State or local laws may prohibit discrimination for other reasons as well. To avoid mortgage discrimination, potential borrowers should shop multiple lenders. Not only will that help you find the best mortgage interest rate, but it could also identify lenders that are discriminating with higher rates or a lack of credit access. Slight differences in rates from one lender to the next, a quarter point or so here or there, are to be expected. But if one lender quotes a rate that seems way off base or declines your application altogether when others didn't, you may want to raise a flag. Of course, if a lender offers you a high rate that seems way out of line, you'll naturally want to snap up a lower interest rate offer and go about your business. Regardless of whether you believe a lender is truly discriminating, it's worth raising the issue, if not for yourself, then for other would-be borrowers who don't shop multiple lenders and might be taken advantage of. So if you suspect discrimination, the first thing you should do is complain to the lender. Says Bailey of the Center for Responsible Lending. She also suggests, contact your state attorney general's office. Consider retaining a local attorney. File a complaint with the CFPB and the Department of Housing and Urban Development. Generally, you should file a complaint within 1 year, but HUD suggests you file as soon as possible. The bottom line, this video should go viral. These racists running these lending places needs to be held accountable. They are destroying hard-working people's lives and dreams. Report these clowns. There is no place for this kind of wicked racism. That's all for now. Please hit the like and subscribe button. Until next time, this is Reno in the Mix. I'm out.